You have $10,000 in your bank account. But where is it? Most people imagine their money sitting somewhere safe inside a giant vault. Maybe there's even a little pile somewhere with your name on it. But a modern bank account doesn't actually work anything like that. When you make a deposit, something much stranger appears on two balance sheets. To you, that deposit is an asset, money the bank owes you. To the bank, your deposit appears on the opposite side, a liability. In other words, your bank balance is partly a promise to pay. And normally, that promise feels almost exactly like holding money yourself. You swipe a card, pay rent, or withdraw cash without thinking twice. Behind that convenience sits an enormous machine of assets and liabilities. Banks hold cash and reserves, but they also own loans and securities. A 30-year mortgage can be valuable without being instantly spendable cash. And that difference becomes extremely important when depositors suddenly want cash together. This is where we meet one of finance's most important ideas, liquidity. Liquidity is basically how easily an asset can become spendable money quickly. And a bank can be solvent while still facing a liquidity crisis. Solvency asks whether assets exceed obligations. Liquidity asks something more immediate. Can the bank produce enough cash when customers demand it right now? Usually, only a small share of customers need large withdrawals simultaneously. That's why ordinary banking can operate smoothly, day after day. But banking has one unusual ingredient that machines can't manufacture: confidence. If enough people stop trusting the promise, their behavior can change immediately. And suddenly, everyone has the same perfectly rational thought: withdraw before everyone else. One withdrawal is harmless. Thousands happening together can become something entirely different. A bank run can become a self-reinforcing cycle of fear and withdrawals. The more people withdraw, the more worried everyone watching can become. This isn't merely theoretical. America learned the lesson at enormous cost. During the early Great Depression, waves of banking panics swept across America. Thousands of banks would disappear, and America eventually rewrote banking because of it. Between 1930 and 1933, thousands of American banks suspended operations. Back then, federal deposit insurance did not yet protect ordinary bank customers. So when a bank failed, depositors could suffer devastating losses. And rumors alone could sometimes make already fragile situations dramatically worse. People rushed to withdraw before they risked becoming the ones left waiting. Those withdrawals forced banks to find liquidity exactly when markets were weakest. Banks could be forced to sell assets into already falling markets. That could create losses, spreading weakness through an already damaged financial system. America eventually decided that confidence itself needed a stronger safety net. In 1933, Congress created the Federal Deposit Insurance Corporation. Federal Deposit Insurance began operating at the start of 1934. That changed something more important than the amount of cash inside banks. It changed what depositors believed would happen if their bank failed. If insured deposits were protected, running first became far less necessary. That's the strange power of deposit insurance. Protection can change human behavior. For decades, that safety net helped make classic retail bank runs less common. But deposit insurance never eliminated every possible source of banking instability. And technology quietly created a completely new problem: speed. In the 1930s, withdrawing money often meant physically reaching your bank. Today, enormous transfers can begin without anyone standing in a physical line. In March 2023, that difference became impossible for bankers to ignore. Silicon Valley Bank had grown alongside America's technology and venture capital ecosystem. Many of its customers were companies holding unusually large bank balances. Much of those deposits exceeded ordinary federal insurance limits. Meanwhile, rising interest rates had reduced the market value of securities SVB held. That didn't automatically destroy the bank, but it created a dangerous vulnerability. Then, SVB announced a securities sale and plans to raise new capital. Customers and investors interpreted the announcement as a warning sign. Messages spread rapidly through tightly connected technology and venture capital networks. Then, on March 9th, customers tried withdrawing $42 billion in one day. By the next morning, Silicon Valley Bank was running out of time. The problem wasn't simply that billions of dollars had magically disappeared. SVB still owned assets, including loans and large portfolios of securities. But customers weren't asking for securities. They were asking for money immediately. That is the difference between owning value and having liquidity right now. To raise cash quickly, a bank may need to sell some investments. And selling at the wrong moment can turn paper losses into real losses. To understand why, we need one surprisingly important lesson about interest rates. When market interest rates rise, older, low-yield bonds generally become less attractive. Investors therefore demand a lower price for those older bonds. SVB had significant exposure to longer duration securities as rates climbed sharply. If those securities could be held, market value changes weren't necessarily immediate cash losses. But massive withdrawals suddenly made immediate cash far more important than patience. That is how a liquidity problem can force losses into the open. On March 10th, regulators closed Silicon Valley Bank and took control. It became the second largest bank failure in United States history at that time. Now, depositors face the question that makes every bank failure terrifying. How much of their money would actually be protected? Normally, FDIC insurance has a standard limit of $250,000. More precisely, coverage applies per depositor, insured bank, and ownership category. But many SVB customers held balances far beyond ordinary insurance limits. So, did companies suddenly lose everything above the standard insurance limit? No. And this is where the SVB story takes another unusual turn. Federal authorities invoked a systemic risk exception after the bank was closed. That allowed depositors to access all their deposits, including uninsured balances. Shareholders and certain investors, however, did not receive the same protection. The government emphasized that taxpayers wouldn't directly bear losses from protecting depositors. Instead, the banking industry's insurance system was intended to absorb those costs. But regulators were worried the panic might spread beyond a single bank. Because the most dangerous thing in banking can travel faster than money: fear. So what does the collapse of SVB actually mean for your bank account? First, bank failure does not automatically mean every depositor loses their money. In an insured American bank, Federal Deposit Insurance provides an important safety net. The standard coverage limit is generally $250,000. But ownership categories can make the actual coverage calculation more complicated. So, don't assume every account at one bank receives another automatic limit. Coverage depends on how deposits are legally owned and structured. For larger balances, understanding those rules becomes increasingly important. But insurance answers only what happens after a bank actually fails. There's another question. How does the system prevent liquidity problems becoming failures? This is where the Federal Reserve enters a completely different part of the story. Banks can obtain liquidity through central bank facilities when eligible collateral is available. That can help prevent temporary cash pressure from becoming something much worse. But emergency liquidity cannot magically repair a fundamentally insolvent institution. And that's why liquidity and solvency must never be confused. Now, return to the $10,000 we started with. Those exact physical bills aren't sitting untouched inside a box for you. Instead, the bank owes you a deposit, payable according to your account terms. And the bank holds an entire portfolio of assets supporting its obligations. Most days, you never need to think about any of this. That complexity disappears behind a card, transfer, or simple cash withdrawal. And that's one of modern banking's most remarkable accomplishments. A complicated financial promise feels almost as convenient as physical cash. But history shows how much that convenience ultimately depends on confidence. The Great Depression showed confidence could collapse across months and years. SVB showed modern digital withdrawals can compress panic into mere hours. The technology changed dramatically. Human fear changed far less. So your bank account isn't really a personal vault. It's a financial claim. And modern banking works because billions trust those claims every single day. If credible news said your bank might fail tomorrow, would you withdraw first?